The relationship between assets, liabilities, and owner's equity is expressed as an equation. The accounting equation is assets equals liabilities plus owner's equity. Assets are the resources owned by the business. The assets are used to operate the business. The right side of the equation represents the claims on the assets of the business. The assets of the business are either supplied by creditors, these are called liabilities, or supplied by owners. Some of the typical assets found in a business include cash, land, building, and equipment. One of the two sources or suppliers of assets to the business is the creditors. Liabilities are the debts of the business. Creditors, therefore, have a right or claim on the assets of the business equal to the total of liabilities. Some of the typical liabilities found in a business include accounts payable, interest payable, notes or bonds payable, and accrued expenses. Owner's equity represents an owner's claims or rights on the assets of business. The rights of the owners to the assets of the business is a residual right. It is equal to the amount of assets that would remain after satisfying the rights of the creditors. Owner's equity is split into two major categories: the equity invested by the owners, called paid-in capital, and the earnings retained by the business. Rearranging the accounting equation as assets minus liabilities equals owner's equity emphasizes that the owner's claim on business assets is a residual claim. Assets minus liabilities may also be referred to as the net assets of the business. We can also use this configuration of the equation to compute owner's equity. For example, if the assets owned by a business equal $100,000 and the liabilities equal $70,000, the owner's equity can be easily determined by subtraction. Therefore, we subtract the liabilities of $70,000 from the assets of $100,000 to determine the owner's equity. Assets of $100,000 minus liabilities of $70,000 equals owner's equity of $30,000.